This is Sonoma Brain Trust. I'm Darren Blonsky with Sonoma Wealth Advisors, Chelsea Runnings with Better Home and Gardens, and Mary Piazza with Veluzzo, Hauser Veluzzo and Piazza in the house today. As you all know, this is a channel that's set up to give you information about what's going on in the Valley. We're three professionals with a desire just to reach out and connect with the community, and started doing this during COVID and have continued. We hope you enjoy the show. Make sure you like it in the bottom because that helps other people find the show. Share it with your friends, your family. And if you want to be on or you want to talk about something you think would be important to our listeners, reach out to us and we'll schedule you on the call if we think you're worthy. No, just if we think you're cool. So we're going to dive into it today. I think we got to cue it into Chelsea to start this thing off. The real estate market continues to rip and roar in the Valley, and there's just so much going on the real estate side. It seems like houses are hotcakes these days.
Yes. Every day, every week, I tell you guys the market is moving. And now that it's officially September 1st, I wanted to give you an overview of what we saw in the Valley for the month of August. And I just pulled my numbers up to tell you guys. We had 68 closed transactions over the whole month. The median sales price was $1,023,000. Sounds better. We saw total closed transactions volume $114,932,266 for the month of August in the Valley. A little bitty Valley. And the average days on market was 38 days. And I think I've said this before, that days on market were longer, not necessarily due to the buyer, but more so because there's so much activity going on that getting appraisers and home inspectors out to the property is taking a bit more time. So it's not the buyers that are taking the time to close the transaction. It's actually just getting the home appraisers out there. I'm in escrow right now, and they had me do a 45-day close just because we needed at least 30 days to get home appraisers out there. So I scheduled a home inspection, and they told me they have never been as busy as they are right now, and they actually need to hire more inspectors just to keep up with the demand.
So it makes you wonder, when's the demand taper off, or does it taper off, right? I mean, I'm a guy that spends his life looking at charts of ups and downs, and the propensity in moments like this is to think, well, shoot, the market's always going to go up, right? So Chelsea, what are the things you look for in your business to kind of say, okay, things might be tapering off, and how do you gauge that and keep track of it?
I look for, when I'm working with buyers, I look to see how many offers are coming in, what the overbid process is like, if there's going to be a lot of overbidding or not. That's typically when I start to tell my buyers, like, maybe we're kind of shifting out of that seller's market a bit more. Right now, I think we are seeing a slight decline, but mostly due to just the environment, like the fires. Nobody wants to be putting their house up on the market when they're evacuating and stuff. I had 2 properties last week in escrow, and both were under mandatory evacuations. So it's hard to say, because I don't think this season or this year's real estate market is anything normal. So kind of guiding clients into, like, this is a great time for buyers or this is a great time for sellers. It's not a normal market. And right now it's still a great time for buyers and sellers because those interest rates are so low. So I'm talking to my buyers about that and trying to show them the difference in what their monthly mortgage amount and a lifetime of a mortgage payment would be now versus in a couple years if they were to take advantage or to buy at a lower purchase price but a higher interest rate. And I think last week about that, is the difference between a 3% and a 5% mortgage rate is like $300 a month, but it's $100,000 in savings over the lifetime of a loan. So,
well, and rates have really gone back up, right? So I was looking at the 10-year, and we're up 36% since the start of August in just the 10-year. So that's going to push mortgage rates up. Mortgage rates aren't exactly tied to the Treasury because in the rates that the Fed puts out, because there is a supply and demand issue. And when lenders tend to have plenty of mortgages to hand out, they tend to charge a little bit more on the rate side. So we are seeing some move up in the rates, do you think that'll slow down the market, or do you think there's just so much demand it won't matter?
I just think there's so much demand right now. It's not really going to matter, especially the longer that COVID plays out and the more that people are working from home and educating from home and just living their lives at home. I think the demand for a stable, permanent home is going to it's going to keep going. I mean,
Really?
You don't want to be in one of those like itty bitty apartment complexes in the city when they're telling you to stay, social distance, but you walk out into your hallway and you have like 6 neighbors around you. It's not ideal.
Very true. So Mary, speaking of COVID, what are you hearing on the legal front with COVID?
Yeah, in the last week, we had a different rollout with respect to the way California has been opening. Governor Newsom implemented like a 4-staged reopening plan depending on the county. And if you allow me to screen share, I can give everyone that link so they know where to go.
Go there. Yeah, you're good. You should be able to share.
All right. So here's the website. It's based on covid19.ca.gov. This is a great resource in general. You can scroll down and it shows the 4-staged based on the number of hospitalizations and deaths, basically. Here's our map of California. You can go per county, and here in Sonoma, we are in the purple zone if we enter that. But even under this, this categorization, there are businesses that are still reopening. And one exciting one that us ladies track are salons. And so salons are now opening at 25%. And a lot of locals are really excited about that. Also, another big thing going on in the legal world right now is, and I've talked about this before, is the eviction moratorium for tenants. In California, there was a proclamation put out by the Judicial Council making today the end of it. So effectively tomorrow in certain counties, there could be a rush of eviction filings. Here in Sonoma County, there's still a grace period with respect to rents that are owing, but I haven't seen any action by the locals. It seems like they want a statewide action to be consistent. But in the next week or 2 weeks or so, I think we'll see some more things roll out with respect to that.
Yeah, that'll be interesting, the eviction notices, because I think we've talked about this in the channel a few times, but if you actually look at the number of people who are not paying their rents, not paying their mortgages, it's substantial, right? And so as that rolls off, and they're allowing people to now get evicted or foreclosed on, how does that impact the real estate market? I think it'll be very interesting to watch over the next few weeks. And especially in cities and areas like San Francisco, which have contributed to a lot of the growth around here.
Yeah, exactly. So you're going to see it in residential and also commercial, right? So there are certain businesses that have basically chosen not to pay their rents, and those landlords are looking to recoup their losses and move on. So it's going to be a dynamic time for our state, as it always is. So I mean, that's the legal wrap for this week, and we'll just continue to keep y'all posted as things come out.
So I had one thing I meant to add that I forgot to add earlier, and I want to kind of trail off of Mary. Fannie Mae and Freddie Mac announced a new fee of 0.5% that they were adding to their refinances to protect them from potential losses. And I think everybody was out refinancing and doing everything. And that was supposed to go into effect September 1st. And that was going to add like upwards of $5,000 for you to refinance your loan. So it was supposed to go into effect September 1st, but they've actually delayed that till the beginning of the year. So if you were thinking of refinancing, you can still go and do that and not get that fee right now.
No, it could be a really good time to refi, with the low rates, I guess.
Yeah, I mean, in rates, it looks like 30 years are back to just under 4 now, from kind of looking around, and which is a far cry from what they were a week, 2 weeks, 3 weeks ago. It would seem. And really, I'll pull up some charts here for the viewers just to kind of see what's driving those rate moves, because you guys know how much I love to nerd out on these charts. So you can see here, this is your 10-year treasury. Back in August, this was a low at 50, basically 0.5% was a 10-year treasury. And you can see we're up at 68 today, and we spiked. So this is really important for people who are looking to buy a mortgage, that you're really shopping those rates, that you're really in communication with that mortgage broker to make sure you're getting the best rates, because there is a lot of movement on the rate side of the fence right now. And that's important to watch. We're continuing to see this real kind of this softness in the dollar across the board. Today, it's actually caught a little bit of a bid up, which is good, because we dropped below $92 today. The dollar's been moving down pretty consistently. It does look like, though, we're going to print an all-time new high today. We'll see when we get closer to the 1 o'clock hour. But right now, the S&P's pushing that all-time high. And then that's what you're continuing to see across the markets, right? You're continuing to see that there's so much capital flowing into the markets. There's a lot of people who have money putting their money in. There's a big disparity between the have and the have-nots. The markets are the have. And that's why you continue to see this kind of disconnect between the economy, the real economy, and the stock market. A lot going on. If you want to hear more about that, we'll put a link in the channel to a larger market update.
Aaron, I have a question.
Sure.
And I know that you're going to want to get into this one. CDC announced this last week that their numbers were a little skewed. 94% of COVID-19 deaths were contributed due to other health factors. I know you've heard that, right? In the last week, you've seen all that stuff floating around.
Yep. Have
you seen this play into the markets at all over the last week? Or do you think that the markets are reacting to this new data?
I think we talked about this last week, but during August, the markets are kind of agnostic to everything unless it's really bad. The reason, because you think about it, your markets are made up, let's just pretend it's made up of 100 traders. Well, 95% of those 100 traders are in the Cayman Islands, or they're in Florida, or they're, hanging out on vacation. They're not in the market. They're not trading. So a lot of the pros are not even trading right now. So the market tends to just float higher. We'll see what happens when everybody comes back after Labor Day, right? We tend to look at the markets right now as not giving us a good signal. So although it's making all-time new highs, we don't put a lot of stock in that, because it could be a completely false signal. Because if 5 traders are pushing the market up and 95% of the traders are not participating, they're just kind of sitting on the sidelines, what happens when 95 come back in? Well, if the 5 made the price action, 95 can change that whole thing. So to get directly to your point, the CDC, it looks like, well, lo and behold, there's not that many deaths coming from COVID. And most of the deaths are because of preconditions that people had. I do think ultimately that's a good tailwind for the market. However, the market is a forward pricing mechanism, so it's very likely it's already priced in. That's why we've continued to tap into all-time new highs. I think really the headwinds for the market's coming in the next few months, the elections. We're continuing to see the polls tighten. The lead that Biden had is starting to dissipate. We're starting to see a more equal race on the presidential campaign. We're also seeing a more equal race in the Senate. So until we have all that information, it's going to be really difficult for the markets to get too far ahead of themselves. Secondly, there was a judge yesterday that ruled that every mail-in ballot that is sent by election day needs to be counted. So think about the complexities of that, right? Because that means that the night of, there isn't going to be a winner. And what markets hate is uncertainty. And so we're going to have a lot of uncertainty coming up over the next 2 months. I think we're going into a big time election. Because you're getting the tightening in the polls, people are going to get feisty. They're not going to be nice. We try to play as agnostic as we can to all this. We certainly have friends and loved ones on both sides of the aisle. And frankly, I'm not interested in losing any friends or loved ones over Trump or Biden. So, I think you got to be careful, but I do think that the COVID data is already priced in. I think people assumed that the deaths were not as bad and the markets looked at it that way. And the bottom line, the Fed's printing so much money that, there's really, at this point, doesn't seem to be anything that's going to stop that printing.
So Chelsea,
Long-winded answer.
oh, sorry.
Go ahead, Mary.
Turning to the real estate market, though, what is September traditionally? Is this like a fast time, or as kids go traditionally back to school, does that have any impact on the housing market?
Yeah, so fall is typically when we see the market slow down. People are getting back in school, they're settling down, and then we go from school straight into the holiday season. So usually we see a downturn in the market. I kind of feel like in the last couple of years too, the wildfires have really played into the market slowing down also. Like Darren mentioned last week, September, October is when we have our fire season, and that's when Sonoma has been affected the most. So of course we see a slowdown in the real estate market because of that. And then just school and everything, like life is like getting crazy again with fall and holidays. Mm-hmm. It's a good time to sell typically because the buyers that are out looking during fall and winter are really serious buyers. And then on the flip side, it's a good time to sell or to buy because people who are selling are serious also. So I don't think that there's really a bad time to buy or sell at the moment. I don't think we're actually going to see that through the end of this year either. I think that it's going to be a pretty even playing field for both buyers and sellers until those interest rates really go back up. And I was actually talking to some new buyers I have, they're first-time home buyers, and they were approved for a certain price and they wanted to offer slightly under. So we offered under, requested a credit, and then of course, like the seller came back and was like, you got to come up, we'll give you this credit, blah, blah, blah. And my buyers were a little kind of freaked out because they didn't really want to come up to like their maximum purchase, like approval price. But when you break down the numbers with the interest rate and everything being where it is right now, a $10,000 increase in purchase price is really like a $30 difference in your monthly payments. It's like a few lattes a month. So for buyers, even coming up to
house lattes. I mean, hey,
you could like go without a few Starbucks for a month. You can come up to that higher price point as a buyer and get that house that you want right now.
Right. But let's not talk about inflation, right? Because that's the other side of it, right? The inflated values that now if you're foregoing lattes for a bigger house, I mean, people are going to be putting more down.
Yeah, it's interesting because I think there's a lot of people that do feel like inflation is going to become a big issue, right? So they're like, yeah, $1,300, $1,400, whatever, it doesn't matter because inflation is going to make that all seem insignificant. Mm-hmm. Who knows, though, right? That's the big gamble right now.
When you see all those charts of like the pay raise through the years, and then you see like I just watched something the other day on how much rents have increased in the last 10 years versus how much pay has increased, and it's like I don't even know how people are able to survive off of how little their pay increase was based on how much their like rent and just life costs were. And I'm just curious, like just waiting to see what this inflation is going to do for everybody in the next like year, months.
Well, that's probably what you do for clients, right, Darren? Like as far as charting out expenses over time and getting ballpark estimates as to living expenses, right? And planning for that.
Yeah, I mean, the financial planning process is about gathering data and then placing it against assumptions about future expected returns and that kind of thing. And when you look at inflation, we typically plan 3% inflation. The Fed would love it to be at 3%. Problem is the Fed messes around with that actual number and what inflation actually is or isn't. So it's really hard to say, but typically when you build a financial plan, you're saying, okay, we're going to plan for 3% inflation. It's very rarely that that's the case. The Fed has really targeted more around 2%, and they're somewhere in that ballpark. Although last week they did come out and change their policy because their policy has been until this point that they're going to target 2%. Now they're saying, hey, we're going to allow more flexibility. Which kind of spooked the market in some ways because the market said, whoa, wait, so you're going to let this thing get out of control a little bit maybe. they said, yeah, maybe. We're not going to be so stringent on it. So that kind of played around with the interest rates, as you saw last week if you were out shopping for interest rates and refinances or buying a house. But that's the key, right? In financial planning, it's about assumptions, and 3% is the assumption we're currently deal with. But it also has to do with portfolio management, right? Because we have to invest clients' assets in things that are going to inflate over time if we expect inflation to come. And you can't put it all in a bunch of bonds, for example, and those won't inflate over time as the same as equity will. So with that, I think we should wrap it up for this week. Anything last that either of you want to offer?
I just want to say, go like and subscribe to our channel, you guys, so we can keep bringing you all this fact over fear knowledge every week, and our special guests that we're trying to line up through the rest of the year. We have some good people lined up and ready to go, so stay tuned for that. And of course, stay healthy and safe out there.
Thanks, everybody.
Bye, everybody.